Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Bob Hoye. He's a market historian and chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim. Here we are, Friday. Friday fun, let's call it that.
And Bob, for fans of yours, just letting them know right now that you'll also be on this weekend's edition of This Week in Money.
Yep, I'm looking forward to doing that one too. So,
Bob, we're getting conflicting information here about U.S. interest rates. The head of the Chicago Fed says rate cuts are needed to spark inflation. Is that a smart thing to do?
Hey, it's theory, and all these theories about intervention and central banking seem just to have been invented out of thin air. Gosh, when you got a business boom, market rates of interest go up. And so do consumer prices, so the rate of inflation goes up. And here's this guy who's head of the Chicago Fed says rate cuts are needed to bolster inflation. And if you take you got price charts going way back, hundreds of years. And in a business boom, prices will go up, inflation will go up, and short-dated market rates of interest, such as the Treasury bill, will go up. And then when it's over, all of this comes down. The T-bill rate comes down. Like, for example, in 1929, with that, famous boom and then infamous boom, the T-bill rate in the U.S. went up until May and turned down in June. And that then was signaling that the boom was over. And I think the way it works, Jim, is that with a boom like that, a large amount of speculation, there's demand through the system for short-term funds for speculative reasons. And then when that changes, the speculators sort of turn before anything, and then short rates come down. And then what also happens over time, like over some months, is that the very careful money out there wants to go to the most liquid items, and the most liquid items are short-dated treasuries in the senior currency, which is the U.S., and so that just parking money drives the rate down. So the Fed is here. So anyways, in 1929, the Fed was still looking at boom conditions. They were conditioned, and they raised the rate, their discount rate, as they called it then, to 6% in the middle of August of 1929. And at that time, the New York Times explained the Fed move as they were going to tighten money to Wall Street because it had been speculative, but they were easing money to Main Street to kind of help out business. So, but that, of course, that didn't work because the bubble was the thing. So anyways, then the Fed didn't lower its administered rate until that fateful October. So what do we have for this year? The 3-month bill rate went up into April and rolled over, and it's come down quite sharply. It's a distinctive decline, and I take that as market forces. So anyways, as sort of in a whimsical fashion in April, I thought, okay, using history, hey, maybe the Fed will then lower its interest rate come October, and who knows, maybe late September. So, but there's a very strange confusion on cause and effect in financial markets. And there's this guy at the Chicago Fed, he's got this idea that if you lower rates, it'll boost inflation. But history says that short rates go up with inflation and go down with deflation. So it's very strange to have such bizarre thoughts and in places of power and influence. And of course, I think what's happening here, Doug, is that the great bubble is obviously becoming very mature, and we're looking at the backside of the slope here, whereby if something is going to go wrong, it will go wrong or be discovered in the fall. And the first half of the year is usually pretty good, which we've had, was what we were looking for. So the public will see. Let's hypothecate a leg down in the stock market concerns maybe and the global economy is slowing. So then all of the trillions of dollars, which are ultimately taxpayers' dollars, that were spent by central bank, the Federal Reserve, to prevent bad things from happening, what's the public going to think when it sees bad things happening? And they're going to say, hey, boys, your theory doesn't work. So here, and then also the history itself says that, because when the original promoters of the Federal Reserve System got together in the early 1900s, they knew that financial setbacks preceded recessions. So then they touted the Fed as then having, or being, a lender of last resort, that they would then prevent financial setbacks, which would prevent recessions. That was the theory. Now, this was also repeated very earnestly in the early 1960s when macroeconomists appeared on the scene, and with mainframe computers, they could model the economy, and that added a stature to what the hell they were guessing about. So even then, that was in the mid-'60s, I remember it, that the Paul Samuelson and other macroeconomists were saying, no problem, we can prevent recessions. So at any rate, the formation of the Fed would prevent recessions, and then in the mid-'60s with macroeconomics and computers, it would prevent recessions. Well, there's been 18 recessions since the Fed opened its doors for business in January 1914. So it's clear it does not work. And this utterance by the Chicago Fed guy shows that he's learned the theory, but he doesn't know anything about the way markets work. And these guys have enormous influence until the bubble fails. And then what happens there, whereby during a boom, the central bank can provide extra or arbitrary amounts of credit, then in the contraction, the power flows to the margin clerks, whose job description is to get the accounts in line, the leveraged accounts in line. And of course, these days, with central banking becoming so reckless, the job description of a central banker basically is to get the accounts out of line. So it's going to be an interesting August, and I think a very interesting fall.
We'll have more with Bob Hoye right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're talking with Bob Hoye. Bob, while the Chicago Fed says rate cuts are needed to stimulate inflation, there's another study that says inflation data does not support rate cuts.
Yeah, that was the
that?
Financial Times, and yeah, there's a debate here. They want to have the rate of CPI inflation at higher than 2%. There's this notion that if it gets under 2%, you'd fall into deflation. But that doesn't happen until the big boom's over. So, again, theories based upon little basic research. So the thesis is that if they lower rates, that will boost inflation, and that will keep the dreaded deflation away. Well, the Fed has done that before, because in the early teens, from 1895, which was the end of that Great Depression, you had prices advance. And then from 1900 to 1920, it was a huge advance in prices, so the rate of CPI inflation got up to 22%. And back in 1980, when the CPI inflation got up to 14%, the whole of the system went berserk. So can you imagine in 1920, up at 22%, and then, of course, commodities crashed. It was a global crash. And so then that fed price pressures in many goods and services. So the 1920s was kind of a doggy economy, and the Fed guys were very concerned about deflation. So what did they do? They were easy with their credit stimulation and thinking that it would boost the economy and boost prices, like wholesale prices. But instead, it was time for a great speculation in financial assets. So financial assets got bid up. So the Fed was blindsided then because their focus was on getting ordinary prices up. And of course, for the last decade, commodity prices have been kind of doggy. And the Fed is concerned about pricing powers of business, and it's trying to get the rate of inflation up. But instead, the arbitrary amounts of credit that the Fed is throwing around, the public takes it and uses it to speculate in financial assets. So the Fed is doing exactly what it did during the 1920s. Concerned about weak pricing power, easy. In the meantime, their great bubble in financial assets is on. And then when they decline and fail, that's when you get a serious contraction. So they're doing the same thing as they did in the 1920s. And the interesting thing is that they don't know. These head central bankers, from what you read about what they say, they haven't got a clue about how the financial markets really work. Now, I ran into this decades ago when I got interested in financial history, and I started reading books that economists had written. And Jim, what you ended up there, after about 6 months of that, I thought, oh my God, all I'm doing is reading the history of ideas, not the history of facts or the history of markets. So then I shifted over to real financial history, which is available in a number of places. So there's a distinction. You've got this theoretical world of economics and central banking that has no way based upon sound research or sound logic, and all it does is make greater the urge to speculate in financial assets when it's the time for speculation in financial assets. So, and then as we know, probability is that if there's going to be a liquidity crisis, it will be discovered in the fall. So once again, for where we started on this one, is that the public, if there is a setback in the fall, are going to look at the amount of trillions of dollars, the taxpayers' money, wasted in trying to prevent bad things from happening. So it's going to be very interesting.
We'll have more with Bob Hoye right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Bob Hoye. Bob, you found an interesting headline that said, "Democracy is the planet's biggest enemy." Where's that headline from and what's it based on?
It was an outfit called foreignpolicy.com, July 21st, and then I looked at that and I thought, well, what it is that control freaks are using the climate story as a means to change freedom and democracy to an authoritarian system. And it's been convenient to use this threat of climate, but hey, climate is what it's going to do. And the terrible things that have been forecast since the 1960s have yet to work out with this stuff. So, and if you go back to, 1992, the Canadian, well, he made some money in the oil business, more strong, and then got into government affairs and United Nations and stuff like that. So in 1992, he said the only way of saving the world will be for industrial civilization to collapse. So another one of these guys who thinks that the climate is some kind of a threat to, or the planet has a health or something like that, and that the only way the planet can be saved is through controlling people. So it's really got nothing to do with climate. And even more recently, in the last 5 years, there's been major figures in climate attached to the United Nations and stuff like that have said we just got to get rid of free market economy and replace it with central planning. But then you have the irony of a totalitarian country such as the former Soviet Union and communist China. Their pollution was extraordinary. So whereas in the United States now the climate freaks are all disturbed about carbon dioxide, which has been a convenient tool. It's got nothing to do with physics. But at any rate, the main large country in the world whose emissions of carbon dioxide are actually declining is the U.S. And that's basically because they've been shifting into more and more electrical power being developed by natural gas plants, and which put out less emissions. So it's been a fascinating promotion, and essentially it is control freaks who want to, and for various bizarre reasons, control everybody. And in physics, the modern physicist Murray Gell-Mann came up with the definitive definition of a totalitarian system. He meant it in physics, but it is that which isn't compulsory is prohibited. It's a very elegant observation, and it's certainly applicable to the experiment in authoritarian governments going on now, whether it's communist, socialist, liberal, Democrat, Liberal Party of Canada. They all want to micromanage your life, and it is that which isn't compulsory is prohibited. And this is what the game is, and the business about climate is just a tool to exert authority. And so, of course, the other one is the government had a number of economic theories they could have chosen, but they chose Keynesian economics only because it allows the transfer of power and wealth to the state. It's a bogus crackpot theory that the state can manage the economy. But hey, if you're in government and you want power, you will support that kind of a theory. And then the other one is the understanding, the basic physics of climate and climate change. And as you know, decades ago I did a degree in geophysics, and ice ages, and they're coming and going, is a subset field in geophysics. And that's natural. Hey, it just happens. But these ambitious control freaks have the audacity to think that they can manage the temperature of the Earth. I mean, this is astounding audacity, typically only seen beforehand employed by Greek gods. So, and the irony is incredible. So say, if we get a recession this fall, then the public is going to say, oops, you guys blew our tax money. And if we get another coolish winter, then they're going to say, hey, we don't, and then at some point people are going to realize that global warming is actually rather good. Increasing concentrations of CO2 in the atmosphere enhance plant growth, and then enhances all life forms on Earth. So all of their theories are just plain wrong.
Bob, thank you so much for chatting with us.
There we are, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.